Today, I'm going to show you the 3 most common multifamily investment strategies. These are the techniques that even the largest multifamily investment groups use to maximize their potential returns on any given project. Multifamily properties are a favorite for commercial real estate investors. If you think about it, this property type offers residential housing, which is familiar to just about everyone and can often be seen as a more stable investment, even during market downturns like right now. So the first step into the world of commercial real estate for many residential investors is through a multi-tenant residential property like apartments. Here are the 3 best investment strategies that you can use to invest in multifamily real estate. Number 1, ValueAdd or BRRRR. Number 2, Opportunistic. And number 3, Core. Today we're going to dive into each one of these, what they are, when to use them, and what else you should expect, because each strategy has a different risk profile and a different level of involvement from the investor. Now, before you embark on your investment journey, it's important that you choose the strategy that's right for you. I know I say that all the time, but it's because it's very important. So first up, we have ValueAdd, or like I said earlier, BRRRR. ValueAdd in multifamily is often referred to as the BRRRR strategy, which stands for buy, rehab, rent, refinance, and repeat. This strategy seems to be the most common among multifamily investors as it can be done on just about any project. I also like to use it on commercial properties, so if you're interested in watching that video, click here. So buy. First, you have to find a value-add property. Now, not every multi-tenant project will need cosmetic updates, although that is one of the more common methods for adding value to a project. You can also bring additional value to a project through better marketing and leasing strategies, more well-tuned operations, creative debt structures, and more. However, you have a better chance of finding a strong deal in properties that will need a significant amount of rehab and renovation. So get ready to roll up those sleeves and do some work. Or hire someone to do it for you. That's what I do. Once you've bought the site, it's time for the operational or the physical rehab. These renovations could be as simple as repainting the exterior and sprucing up the landscaping, or as intense as fully gutting and rebuilding entire units. The whole goal here is to achieve higher rental rates because of these renovations, which is going to give you higher value on the property. So other than the absolute necessities, such as roof and HVAC, only rehab the aspects of the property that tenants will find valuable and for which they'll pay more. If you're taking a more operational value-add approach, be sure to hire the right property management company and create systems to cut costs where you can, while still providing a quality product. Then you rent it to tenants. Having the right leasing and management team is crucial here. While you're certainly looking to maximize the value of the property, I feel it's better to get good rents fast than to get great rents slow. Everyone certainly has their own preference though. My thought process on taking good rents is that it will allow the project to lease up faster and more aggressively, which will get me to the refinance faster. However, if you have the best leasing team around, they may be able to achieve your timeline with great rents. When we buy right, we can rehab and offer our product at below market rates, which puts us above and beyond our competition and makes it very easy to lease up that project. You can always raise rents after you stabilize the asset. So now that you're stabilized, refinance. Once you've stabilized the asset, which is typically around 85 to 90% occupancy, it's time to refinance your commercial loan. You've added a significant amount of value to the property by increasing your net operating income by making the property more attractive by rehabbing it. You raised rents for incoming tenants. You've lowered your operating costs. So not only have you raised the NOI, but you will likely benefit from a lower cap rate since you improved the operational and aesthetic quality of the building. You might be able to pull out 100% or more of your original capital investment while still cash flowing the property, which is a pretty incredible aspect of the BRRRR strategy. The final step, repeat. Keep growing that investment portfolio. After all, if you're able to pull out all or most of your initial cash, you should have an easy time snowballing your momentum. Our second strategy is opportunistic. Opportunistic real estate investing is on the higher end of the risk profile for commercial real estate investments. It's also on the higher end of potential returns if executed correctly. These projects are similar to ValueAdd, where the investors will have to be rather hands-on, but cash flow may or may not be of a concern or goal here, because the opportunistic upside of these deals usually comes from the sale or the refinance of the investment once it's completed. Opportunistic deals can be heavy value add, land assemblage, land banking, and land development. So let's dive into those 4. Heavy value add. I know what you're thinking. We just covered value add. But the opportunistic side of this is the heavy part, meaning a significant amount of renovations or lease up must take place. These properties are typically older, likely require an immense amount of cosmetic and structural updates, and could be completely vacant. Depending on the size and condition of the structure, this process could take you 18 to 24 plus months from start to finish. Land assemblage. Land assemblage is the assembly of multiple parcels of land into one. Once these parcels are assembled, they are often more valuable to developers since they may now execute larger scale projects. Assemblages can take years, if not decades, though. Many investors that take this path will also shroud their strategy in secrecy by employing multiple brokers and attorneys to help acquire the parcels. They will also utilize different entities so that no one knows who the true owner is, which helps prevent holdouts. If one of the owners decides to hold out and refuses to sell, or the path of development doesn't move your way, this strategy could be unsuccessful. Land banking. Instead of placing capital into a bank account, these investors will purchase tracts of land. These parcels, which are hopefully in the path of development, will increase in value over time as everything around it is developed or improved. At least that's the hope. Land banking can be fairly risky because there is little to no income flowing on the property, and there's certainly a chance that development heads in the opposite direction or stops altogether. After the land has appreciated in value, land bankers will then sell their land at that higher value to end users or developers, or they could partner with them by contributing the land as equity into a deal. Land development. Development is the re-envisioning of a property either previously developed or completely untouched. Developers are responsible for an immense amount of strategic planning, financing both the equity and the debt in the development, construction, and lease-up or sale of the project. This strategy may just have the highest risk and reward of any commercial real estate investment strategy. Once the project is completed, developers will either place long-term debt on the project and let it cash flow, or sell it at a premium to larger investment groups who just want a new, stabilized asset. Now, our final strategy is core. The core investing strategy is quite the opposite of value add and opportunistic. Core investing is the acquisition of highly stable, low-risk assets. Characteristics of core investments include located within a primary or major market, fully leased assets, high credit tenant base, and Class A or trophy buildings. This strategy is often utilized by hedge funds, life insurance companies, and other investment groups that are just looking for reliable cash flow and want to preserve their capital rather than take the risk on growth. These assets will also trade for the lowest cap rates in their market. There are 3 different types of core investments: core plus, stabilized assets, and trophy assets. And a single property could have all of these attributes or just one. Core plus. Core plus investing is often referred to as a strategy separate from core, but it's really just a variation of the method. Core plus is essentially a hybrid of value add and core, where investors will find a less risky investment with slight upside. They may find that upside in small cosmetic improvements such as exterior or interior paint and new flooring, utilizing internal property management where they can keep those fees in-house, hiring a better leasing team to fill the vacancies that they may have on the property, and several other ways. These projects trade at slightly higher cap rates than core since they may have higher vacancy rates and are slightly higher risk. However, don't forget that these properties are still high quality and relatively stable assets. Stabilized assets. Stabilized assets are properties that are fully occupied or very close to it with little to no deferred maintenance. Incoming investors simply need to keep operations flowing as they are in order to realize consistent cash flow and low vacancy rates. Because they require little work for incoming ownership, stabilized assets will trade for low cap rates. Many investment groups choose to skip over these properties since the returns are often too low. Trophy assets. Trophy assets are the most well-known buildings in their markets. These may be the latest addition to the city skyline, the tallest building in the city, or the largest development within your market. They are often in the best locations, have the highest visibility and easy access, which creates strong demand from potential tenants and higher rental rates. Multifamily properties with trophy status are often held for long-term appreciation. So, there you have it for the 3 most common multifamily investing strategies. Your appetite for risk and how much work you're willing to put in and the market that you're investing in will certainly help determine which strategy is right for you. Now that you know how to invest in multifamily, get out there and go find your next asset. Don't waste any time liking this video. Definitely don't subscribe for more commercial real estate investing strategies, leasing tips, market updates, and more. But if you do have any questions, leave me a comment below and I'll be sure to help you out.